Hey, good morning, everyone. Marty Mazzora here, August 7th, 2021, with your weekly macro update. Gonna stick just to the macro, just to economics this morning, because I've got plenty to show you and I don't want to keep you too long. I would like to dig deeper into markets, equities, commodities, credit markets, and so on. I'm thinking what I'll do is when I update our technical charts here over the next day or three, I may shoot a video and kind of run through all or a good chunk of our positions and have you see what I see from a technical perspective. And that always gives me an opportunity to explain the fundamental reasons why we're in what we're in currently. But for this morning, let's just talk economics. And this is our PWA macro index. And as you can see, we continue to roll over. Not a great look. 25 is this week's score, down 4 points from last week. Still a ways to go before we enter what we believe to be conditions where odds favor recession over continued expansion going forward. So right now we're in the continued expansion camp, but that of course is always subject to change and subject to what the data tell us. But again, not a good look, but not something that would have you batten down your hatches necessarily. Of course, there's a lot underneath that by way of artificial stimulus and things that we've hit pretty hard here on the blog and that we will continue to as things evolve going forward. Our index is composed of 48 data points. What deteriorated week over week were auto sales, consumer debt outstanding, consumer confidence, and the copper price trend. What improved were weekly jobless claims and then the BLS jobs number at the end of last week. So I'll just run through those charts for you real quickly. Starting with auto sales, as you can see, we have rolled over pretty hard of late. Now, of course, that begs the question, is that because people are hunkering down, losing their jobs, afraid of the future, heading into recession? Well, no, it's because of the bottlenecks, creating a scenario where there's just no inventory and prices have gone through the proverbial roof on cars, used cars in particular. Now, the chart does say what it says, and of course that scenario could morph into something worse, but clearly that's a very negative look, deserving of a downgrade within our index. And so the purpose of the index, folks, is to score it as the charts show it. Of course, there's lots of critical thinking that goes on underneath to determine whether or not this is actionable within our portfolios. But in terms of scoring from an economic assessment perspective, that is an unambiguous negative at this point. Now, consumer debt outstanding, you could argue that when consumers are feeling confident enough to ramp up their debt, well, then that's positive for the economy. And actually, this had been scoring positive in our index. This, folks, is just a little too much of a good thing. The consumer ramping up debt side of their balance sheets, while again, presuming that that's money that's going into the economy, what happens on the other side of that? And this also gives you some insight. This along with household equity exposure, along with all the corporate debt that is just enormous. And also, of course, the fact that we're nearly 130% debt to GDP. Therefore, the powers that be are leaving no stone, no mechanism unturned, compliant with the Federal Reserve Act or not, to keep these bubbles afloat. If it's going to work from a policy perspective, it's going to need lots of fiscal help, and that's government deficit spending. But you can't have government deficit spending and a huge supply of government bonds hitting the market amid what is clearly an inflationary setup. Now we can argue whether that's short-term or long-term. We're in the longer-term camp. You can't have the rising interest rates that would coincide with that narrative without bursting these asset bubbles and debt bubbles. So then we have a Federal Reserve that has to resort to the 1940s and that is where it is in the bond market while inflation is running hotter than they'd normally allow. The inflation serves to ultimately cure the government debt to GDP problem, right? Because if you can inflate the economy nominally and get GDP up there at a pace faster than you're growing the debt, well, then the debt as a percentage of GDP goes down. Weakens the dollar dramatically, not a good thing in many respects, but it does accomplish what the powers that be aim to accomplish. I see virtually no other way out of this. So those who say that those like me are silly when it comes to believing that after all these decades, inflation is upon us, well, number one, it better be. And number two, not so silly when you consider all of the longer term structural evolutionary things that I've written a lot about. Deglobalization for sure, populism, which is consistent with that, China's economy evolving into not so much the manufacturing hub for the world, what I just mentioned about the Federal Reserve, huge lack of capacity in the resource sector, so we don't have the capacity to produce all the copper that's necessary to fulfill these mandates around carbon emissions and everything else that goes with, renewable energy. The lack of expanding fossil fuel production capacity in everywhere virtually except for the OPEC states. And of course, mining all of the metals and rare minerals necessary to pull off this switch to a carbon-less world is going to burn a lot of fossil fuels. So I actually believe oil prices will trend much higher over the next few years with some big volatility in the meantime. I'll stop there because I do want to get more into those weeds, but I want to do that on a separate video. Consumer confidence, bulls definitely don't want to see this. So you have consumer confidence rolling over a bit. Could be, due to the Delta variant. Consumers are beginning to feel the inflation pinch. The University of Michigan, you can see its survey is rolling over. The weekly Bloomberg Comfort Index as well. And the Conference Board's index looks like it's flattening out a bit. This is a look that is concerning, of course, when you consider that we are, 2/3 consumption in terms of what moves the U.S. economy. On a positive note, initial jobless claims dropped below 400,000 again, and continuing claims continue to trend lower as well. And then non-farm payrolls saw a huge jump, 943,000 new jobs for the month of July. Now we still have 6 million folks who aren't working compared to how many were working pre-COVID. And that's going to continue, I think, to provide fuel for the Fed's, at least the majority on the boards, penchant for easy money policy as far as the eye can see. They'll leverage the folks who are still on unemployment as long as they can, and they'll leverage anything else. But ultimately, like I keep saying, folks, well, at the margin, they'll tighten policy on the quantitative easing end, I think, for a bit before they have to resort to yield curve control, assuming that's right. And that means the $40 billion a month of mortgage-backed securities, I think that'll go first, and then the $80 billion a month of U.S. Treasury purchases. They're going to see if they can cut those a bit, taper those back without destroying markets. Of course, that remains to be seen. I think the market is not going to like in a big way anything they do or seriously threaten to do. But we'll see how it plays out. But for the time being, they're going to need to play lip service to monetary tightening because of what they're seeing on the inflation screen and the pressure that they're getting on that. Copper price rolling back over a bit, although Friday it did come up and recapture that green line, which is the 50-day moving average. I'm bullish copper long term. I just suggested as to why here a second ago. As we were looking at this and the commodity index chart, folks who've been watching these videos consistently know that just is unsustainable, this big parabolic rise. So expect some serious correction. China has helped that out a bit by really talking down the market, releasing some of their own state-owned reserves into the market to try to get the price lower. Very temporary stuff that ultimately doesn't work. If the fundamental underpinnings are bullish copper, definitely big regimes like China's can impact at the margin, or they could cut their fiscal support for their economy in a big way, and that would certainly bring copper prices down. In the long-term scheme of things, we have some structural changes in how this economy and how the energy space is going to be approached, and that's very bullish copper for quite some time going forward. But we're talking a lot of volatility, of course, particularly when you have big rises like that. So this one didn't change our score, but I wanted to show it anyway. This is the Global Purchasing Managers Index, so of countries worldwide, what their purchasing managers are saying about their prospects going forward. Above 50 is expansionary, but we have to pay attention when these things begin to roll over and see what's going on under the surface, parse those reports, listen to what they're saying, and think about whether or not this looks to be the beginning of a downward trend or just a consolidation of attitudes and sentiment after a nice run up. And then the amazingly high level of the Baltic Dry Index, the cost of shipping bulk across the world's oceans. We are seeing huge inflation in the transportation space. That tells you that right here. Didn't move my needle this week on the index, and normally you'd say that's hugely bullish, right? That denotes huge demand. What also denotes huge bottlenecks. So as these bottlenecks open up, of course, we'll get this chart will get very, very noisy. But this is what it looks like, when we're heading into recession, right? This is what it looks like when we're coming out. So, folks, I think I will just let you go right there because I think I'm going to be back with more on the video, and I'll try not to make each one, a marathon, and give you more insight. There's more I want to talk about in the markets. Technicals are looking interesting. Commodities, gold in particular, is looking interesting. I want to share with you our narrative here on the video. I do a lot of that on the written blog, but some of the feedback I get from many of you is you prefer the video, so I try to mix it up. So give me a few days at the most, and I'll try to swing back with something very equity and commodity and credit market oriented for you that I think that you'll find hopefully interesting and certainly instructive in terms of, for you clients, how we're approaching your portfolios right here. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend. Talk to you soon. Bye-bye.